We got a great question from QC up next. He says, does it matter if you invest in mutual funds versus ETFs and taxable brokerage? I picked this one because recently, I think it was last year or the year before, there was a big news story about one of the big providers, and a lot of people owned mutual funds in their taxable brokerage account, and it caused a lot of tax consequences. So can you guys talk about that?
Yeah, so one of the questions that people probably ask is, what are the differences in mutual funds and ETFs? And when you kind of dive into those differences, well, does it make sense to hold different types in different types of accounts? Now, the one thing I'll say, Brian, as you answer this question is that it's important to know not all are created equal. Not all mutual funds are just the exact same. Some of them are more tax efficient, some of them are less tax efficient, but maybe talk a little bit about differences in mutual funds and ETFs, and can you hold them in taxable, or is one better than the other?
Yeah, first, I mean, mutual funds are, a basket of funds, and they do typically have of stocks, bonds, whatever the manager's putting in them. And it's true that they run either embedded losses or embedded gains, and since markets are typically up, 8 out of 10 years, there's typically more likely embedded gains. And then you have to pay attention to what's called turnover ratio, meaning how often is the manager or the portfolio inside of there being traded, buying and selling? Because every time you buy and sell, that creates a taxable transaction. This is one more reason why we love index funds versus active management, is index funds just don't have a lot of turnover. Just naturally, the only turnover is when they take off the whatever funds, like if you take the S&P 500, whatever companies now fell outside of the top 500, those come off, they add whatever the 5 new ones that kind of grew into the S&P 500. That's the turnover, very low percentage, not a lot of transactions from that. So you just don't spit out a lot of income when you're doing index investing. Now, so that's kind of, I told you, active management's going to have a lot of turnover, so it's probably going to be less tax efficient. Index funds don't have as much turnover, so they're going to be much more efficient. But then there's also, now you got mutual funds versus ETFs. Well, ETFs are naturally indexes, so they're already tax efficient, but they also, instead of it kind of being embedded inside of the portfolio, it's kind of just a natural flow through process. So what I always tell people, because look, when markets are getting their teeth kicked in, sometimes it's better. Mutual funds can actually have embedded losses that's actually going to provide a tax tailwind, meaning that you could actually have gains within the portfolio that you're not going to pay taxes until it makes back those losses and then gets into gain territory. And you have to look at the timing. So I would encourage you, go use tools like Yahoo Finance, Morningstar. You can start looking at mutual funds and see what they have in embedded gains and losses to use. But here's what I also say about the timing. If you are buying, beginning of the year, look at those embedded gains and losses, use that as your guiding factor. If you're kind of at the end of the year, so I'm talking about like fourth quarter, and you're worried about those November and December capital gain and income distributions that will flow through usually and get dumped out at the end of the year, ETFs are much more consistent on not dropping those tax bombs on you. I know in 3 minutes I just loaded them up, but I mean that's kind of the way I'd handle it. I just did a full Q&A or almost a mini show in 3 minutes.
The only thing that I would add to that is early on in your investing journey, I wouldn't get lost in those details as much, right? Like I think if you're just starting out, it matters more about how much you are saving than what you're saving into. It's one of the reasons we talk about loving low-cost target retirement index funds, where all you got to do is decide 2 things. When do I think I'm going to need the money? How much can I save? If you can answer those 2 questions, you can just start plowing it in, whether it's in your Roth or your 401k or your after-tax brokerage account, and let those dollars build up. You shouldn't really worry about the taxability of those at that stage. I think that's what Daniel was referencing. There's a big fund company, one of their target retirement funds a couple years ago had huge capital gain distributions. Well, that's less than ideal, but again, in the beginning of your journey, focus on the things that have the biggest impact. And the thing that has the biggest impact at the early part of your journey is your savings rate. So don't major in the minors early on. Buy a low-cost index fund, buy low-cost target retirement index funds, or use low-cost ETFs And I think you're going to likely set yourself up for long-term success.
You came back to it perfectly there, is that when we say low-cost target retirement funds, we prefer the index variety of target retirement funds because they are tax efficient, they're super low cost. And do your homework, guys, because I know there's been a lot of bad press about target retirement funds. Go out there and look at the different asset allocations for the year, because remember, it's as easy as Bo said. How much can you save a month? When do you need it? But then go look and see what the biggest providers like Vanguard, Fidelity Investments, Charles Schwab, look at their index target retirement funds, see which one kind of reflects your desire, and then let it rip. Make something happen, and I think you'll be very pleased that you will have that automatic for the people inevitable wealth plan that's going to make it happen for you.